Hello, welcome back everyone to our continued discussion of Chapter 11. We're talking about individual sponsored retirement plans, those that don't require an employer to do anything like we did in Part 1. So these you've also probably heard reference to, but the two most common that we come out that you'll hear about is the traditional IRA. Before we had a non-traditional, it was just IRA. But now that we have two kinds, you have to be specific whether it's a traditional IRA or a Roth IRA. And the contributions are the same, limits are the same, $6,000 or 100% compensation. Now, when we talk about compensation, that's earned income, that's wages, that's income from a Schedule C business. I will tell you that I ran into a situation where an individual that I work with do their tax return wanted to make an IRA contribution. Their only income is from rental properties. That did not qualify as compensation under the law, and so they could not make any IRA contribution because they have no compensation that qualifies. The age over 50, the adult limit is $7,000, a whole extra $1,000 as a catch-up. Remember that those amounts were much higher for employer-sponsored plans, which is why those employer-sponsored plans are more, you might say, advantageous or more attractive than these individual ones. If you go with the individual ones, you don't have to get the employer involved, but you have these lower limits. And then it can get worse. What if you work for an employer that has a plan and you want to do your own plan as well? Maybe you're not happy with it. Maybe it's not enough. Okay, then you have some issues with that as well. Meaning you can do the $6,000 or $7,000, but your ability to deduct it gets phased out based on your income. So if you participate at work in your employer's plan, on your single, then your ability to also set up an IRA, a regular IRA, and deduct it starts to go away when you reach $66,000 of income, and is completely gone by the time you get 76. So you can still put in the $6,000 or $7,000, but it's not deductible. It doesn't help your taxes currently. So we go back to the principle that if you put it in without a deduction now, when you pull that money out after retirement, it would not be taxable either, but that's kind of usually not much of a consolation. It phases out later if you are married, okay? So that is the deduction part of the IRA. And if you are, again, have a plan at work. If you don't have a plan at work, these don't apply. Okay, this is only if you're covered at work. Now, married taxpayers have an additional thing to think about. Okay, and that is if they don't participate at work, does their spouse? Okay. Now, first of all, you can set up an IRA for your spouse even though they have no income. So if one spouse works and the other one stays home to take care of the kids, or for whatever reason has no earned income, then as long as the working spouse or the one that's working outside the home makes more than the $12,000, they can put in for both. Okay, so that's cool. That's a good benefit there. Okay. But if your spouse works and is covered by an employer plan, and you do say something else and you're not covered by an employer plan, okay, you could still have a limit on what you can put in or what you can deduct when you put in if your total AGI together is too high, okay? So as long as you stay under 198,000, you can put it in, okay, if only one spouse is covered by the plan. So there's a higher limit for when that phases out if you're the spouse of someone who works at a place where it's just covered by a plan, okay? So that's a little extra complication that if you're married filing jointly that you need to consider is if your spouse is contributing to participates in a plan at work, then you could be limited in how much you can put into your IRA and deduct, even though you personally do not participate in an employer plan. Now, Roth IRAs work differently. So a regular IRA is deductible, and that's why there's rules about how much can be deducted when you put the money in. So you take it as a 4 AGI deduction on the 1040 in the year that you put it in. You have up till April 15th of the following year to put it in. So for 2021, you have till the April 15th of 2022 to put the money into your IRA and count it for 2021 and deduct it on your 2021 tax return. The Roth IRA contributions are not deductible, and they have benefit that we talked about earlier, that if that's the case, then when you pull money out of that Roth IRA when you retired, that is not taxable income, okay? So just the opposite. If you put money into an IRA and deduct it, and then when you retire, take it out, you're going to pay tax on it, okay? But the issue is you still have situations where you can't put money into a Roth IRA. Even though it's not deductible, you can't even put money into it. In fact, if you put money into it, you'll be charged an additional tax on excess contributions. And that starts at $198K if you're married filing jointly, $125 if you're single or hetero household, and $0 if you're married filing separately, another penalty for married filing separately status. And the range phases out, okay? So you can't, if you're married, and notice the backwards here, the married filing jointly only has a $10,000 phase out, and the others have a $15,000. Usually it's the other way around with these phase outs. So this phase out for married filing jointly starts later, but it's only $10,000. So as you get to $208,000, you cannot make a Roth IRA contribution according to the law. So you can't put money into a Roth IRA. That is not an option. Okay, so the limit on regular IRAs is what you can contribute. I mean, with what you can deduct. There is no deduction for Roth IRA, so now then they limit what you can actually put it in at all. Okay. So there's the reminder of the differences between the two types of plans. That's why it's so important that we know which one it is if we're dealing with a client or situation. Okay? So traditional and Roth IRA are the two different individual sponsored plans. A little review, okay? Well, individual with age of 30,000, haven't even got close to our phase out of the deduction, okay? We're over 50, so it's not just $6,000, it's an extra $1,000 or $7,000 that you could deduct. Not that if you're making $30,000 you can afford to put in $7,000, but if you could, that would be the amount you could deduct. Okay. So a married couple who are not participants in an employer plan with earned income of $200,000 are ineligible to make deductible contributions. False. Okay. If they don't participate, neither one of them participates, then literally they can have whatever the income is, as long as they can still make a deductible contribution to a traditional IRA. There is no point at which the income alone, as long as you don't participate at work with an employer plan, where that phases out. And general distribution Roth IRA not taxable. That is true. Very flexible in pulling money out of a Roth IRA and having it not be taxable. Now, a similar type of plan. This is not for retirement. This is for education. Okay, it works like a Roth IRA in that the contributions are not deductible. If you make money inside the plan, and all of these plans, when the investments inside the plan make money, you don't have tax on that. But this can grow that way, and then you pull it out, okay, to pay for qualified elementary, secondary, or higher education expenses of our beneficiary. Typically, someone, one of your children or grandchildren, okay? So you can set up the plan for yourself, but typically what happens is parents set them up for their kids, and then they put that in. But notice how the limit is in place. Only $2,000 per beneficiary. Okay, so that's not very much money, and you can't put it in if your income is too high. Okay, so it starts to be phased out at $190K if you're married filing jointly, and $95 for others, and completely gone by the time you get to $220 on the married filing jointly. So that's not going to be an option if your income is too high in terms of how to save for your children's education. So these education can grow, and then you pull the money out to pay for education down the road. Now, what often happens is, the problem is you have to establish an account well before someone goes to college, and so the question to have any possibility of getting money into it for that individual, and what if they don't want to go to college and stuff like that? You've got those issues that then what do you do with that money? Now, there are some rules that say you can roll it over to one of your other children or to grandchildren or something like that. But it basically, if you pull it out and not for education, you're going to have a tax on the interest that you've earned during that time period, and penalties perhaps. All right, a better way that has come up relatively recently is a tuition savings plan called 529 plans. The earnings grow tax free, meaning not, in the sense that if it earns interest, you don't have any taxable income, and if you then pull that money out to pay for education, you never pay tax on that income. Okay, education expenses of qualified educational institutions. Notice that computers, if required, room and board if you're attending at least half time. So very broad in what it can pay for, and you don't have that $2,000 limit of money going in. Okay, so it's got a lot bigger potential to save money and to do that. But there's a limit coming out, meaning there's some only $10K per year can be used for tuition at K through 12 schools. So that's private schools, but that doesn't apply to higher education. Okay, if you pull it out and it's not for education, you've got a 10% penalty. You can roll it over from one family member to another if they don't use it all, or they don't want to go to college, or do something else with their life. Okay, you can do both this, your education savings account, and a qualified tuition plan. Now, what is issue we learned about education credits? When you pay for tuition and things like that, there are credits involved. Okay, if you use the money out of one of these plans to pay for that tuition, you can't also take a credit for that tuition. Now, if tuition is $20,000 and you take $10,000 out from a plan and pay for $10,000 towards tuition, and you pay the other $10,000 out of your own pocket. That part that you pay out of pocket could be used for those education credits we learned about in Chapter 9. Well, as long as you have additional expenses besides the ones you pay with the amount from the plan. Okay? So check ourselves a little bit. Colonial educational savings accounts, contributions are not deductible. That's true. You don't get any current tax benefit. Okay? And it's $2,000 maximum. All right? And then you phase out when you reach $95,000. Distributions for qualified tuition plan can be used for a computer, and as was one of the list of qualified education expenses is required for to be used at the educational institution. So, talking about money coming out of IRAs, employer-sponsored plans, the individual plans, distributions from any of these savings vehicles for education, okay? Remember, the general rule is if they were deductible when they went in, they're taxable when they come out. But if there's a mix, if some contributions were you got a deduction for, and some contributions you didn't because of violation of some of the rules, or you went over the limits or something like that, okay, you may have tax-free and partially taxable. In those cases, the amount you pull out is determined, that is not taxable, is determined using the simplified method. Now, the simplified method is actually in your textbook. There's some tables in the back of the chapter 11 in the appendix, but the simplified method is in the actual chapter, okay? And basically, it's a list of how many months you think that the IRS determined is you're going to be paying out, if depending on your age. And there's only like 5 or 6 categories, okay? So it's a relatively straightforward thing. What you do is you take the amount that you are of your IRA or your account that is non-taxable because it was already taxed previously, and you simply divide it by the number of months that it says in that little table in your textbook, and that's how much you get out of when you pull money out. That's how much you get tax-free. So if you did that calculation and you found out that your amount that you got monthly is $300 tax-free, but you actually get $600, then you'd have a $600 cash receipt each month. $300 would be non-taxable, $300 would be taxable. Okay? So that's how you use the simplified method. Now, that's if there is a mix. All right? Now, there's another situation, and this applies to IRAs, 401ks, whatever, that you reach a situation where you have to, are required to make distributions. Regular IRAs have a required minimum distribution, and that has to start if you turned 70 and a half prior to 1/1/20. Starts when you're 70 the next year. Okay, if you're not 70 and a half by January 1st, 2020, then it starts when you turn 72. They changed the law. Okay, and that RMD is based on the life expectancy tables from the IRS Table 3 in your appendix to Chapter 11. So that's different than the simplified method. Simplified method is for mix. This is where all of the money is taxable, and that we're needing to figure out how much we have to take out. All right, you can take out more than this. This is the minimum. And you have to start distribution. You can't just leave your money in the IRA until you die. Okay, even if you don't need it, you have required do that, and you use them every year. Okay, you go back to the table because there's a different number of years for each year of your life. So if you start with the 72, right? Okay, and then the next year you go back and you use the 73 on the table, and then 74, and you take the value in your IRA at the end of the previous year and divide it by the new number that you get from your life expectancy. Okay? All right, and then distributions from Roth IRA are generally not taxable, right? As long as they stay in there 5 years, okay? And even then, you always pull out, okay, the amount you put in first before you have to have any taxable amount of interest, okay, even if you don't reach the 5 years, okay? And then as long as you fulfill the rules in terms of spending money on the education, that's what determines whether the withdrawals from a tuition savings plan or an education savings account is taxable. Okay? If you pull out money from an IRA or 401k or some of these qualified retirement plans other than a Roth IRA, right, then you're going to be subject to a 10% penalty. And the Roth IRA would be subject to it if you pulled it out in less than 5 years. Okay? So there are some exceptions, and there's a list, and those get changed every so often, usually, and that's gotten a lot longer over the last few years. Okay? And then typically if you want to move your IRA from one trustee to another, the best way to do it is to do a direct rollover, and literally you tell one trustee, remember the trustee is the third party that's just holding the money for you, okay, to send it to another one. So you decide that you want to use Fulton Bank instead of Effort and National Savings Bank or whatever, okay, you can do directly over that, and if you tell one to just send it to the other, then you won't have a problem, and they'll mark that when they send it to the IRS. They'll say that was just a rollover. If you pull it out, okay, and then take it down to the other company, you're going to have a problem because the one that you pull it out is going to send to the IRS that you pulled it out, and they're not going to know about that rollover. All right. However, you still can in 60 days, as long as you put it into a new account in 60 days, you're good. But you're going to have to prove that to the IRS with the proper paperwork that you did that, all right? Otherwise, you're going to have the amount you pulled out taxable. And so the best way to do it is do a direct transfer. But if you mess that up and it doesn't happen, you can still have 60 days to fix it, and you'll still be fine as long as you keep your paperwork and can prove that. Okay. So check on what we learned so far in this part. Participant in a defined benefit plan is only entitled to only a stream of payments. True, remember, defined benefit is a promise to get a certain amount every month or year. Okay. Distributions from qualified pension plans may be taxable, non-taxable, or both. Typically taxable, but there can be a mix of things. All right. And if it's a Roth IRA, it could be non-taxable. And then just practicing that simplified method we learned about, anticipated payments from a pension plan for a single individual age 68. You look that up in your textbook, 210. So you would take the amount of non-taxable and divide it by 210 to see how much each payment would be non-taxable. Okay. And the same thing with another situation with age 60, 59, 63, if you're using two people, okay, married couple that both will receive it, 310. And again, you take the amount of non-taxable, divide by 310, and distributions are required and you reach age 72 now, and it used to be 70 and a half. All right, then you have to take distributions. You cannot just leave it alone. You have to pull it out. The IRS wants the tax on that money that you put in to that plan.